Welcome everyone to the Pump and Dump channel. Today I would like to talk about the recent sell-off in the stock market and the rally into the bond market. There's been a lot of news about that in the last few days, and the story is usually implying that investors are becoming cautious and moving out of risky stocks and into the safe haven of treasury bills. Now, looking at the transcript from the Chairman Powell press conference, we can see here that they decided to lower the federal fund rate by a quarter percentage point to a range of 2% to 2.25%. And just to explain, for some people probably won't know this, but the interest rate and the price of bonds are inversely correlated. So the higher the bond price is, the lower the interest rate that it is paying, because the coupon is fixed. And the same is when interest rates are rising, the coupon is still fixed but the bond price is lower. So I'm just going to draw here a line. Up here we're going to put the higher end of the bond prices at 2% and the lower end at 2.25%, which the Federal Reserve is targeting. And the way they do that to reach these objectives of keeping interest rates in this interval is, on the downside, they prevent bond prices from falling below a price level that implies a 2.25% interest rate by buying in the open market when investors are fearful of owning bonds and selling them. So they will buy unlimited amounts. Here they are, the issue of the currency, the so-called buyer of last resort. They have unlimited amounts of money, so they can buy as many as they need to. On the upside, we have this 2% here that they are trying to prevent interest rates from falling below, according to their statement. And the way they do that is they sell the same kinds of assets like mortgage-backed securities or treasury bills into the market when the market is trying to buy them. Now, getting back to the transcript and looking at the reason why we went below this 2% interest rate, we can see here this key sentence where they mentioned that they decided to conclude the runoff of their securities portfolio in August rather than in September, as previously planned. Now, a lot of people know this as quantitative tightening, which is the sale of their assets, on their balance sheet, the mortgage-backed securities, the treasury bills that they are selling into the market, and they had been selling them for, I guess, 4 years or so. I think they started in 2015 or 16, and they were selling something like 30 or 40 billion dollars worth of assets into the market every single month. And this ceasing to sell them is kind of indicating, at least from how I understand how it works, that they are saying that this 2% that they are targeting is not being defended anymore, because when the market is looking to buy bonds and the Federal Reserve has a large balance sheet filled with treasury bills and mortgage-backed securities, the market can't beat the Fed. It's like that saying, don't fight the Fed, and the Fed has all these assets they can sell to you, so if you try to push the price against them, they will just push you back. But they're saying essentially here that they are no longer doing that. Quantitative tightening is over, so the market kind of immediately dropped to 2%, and after the stock market started selling off, which I see as these money managers or investors as raising capital, selling everything they can just to get the money to buy the bonds. And at 2% we broke through that line, and I saw it as low as 1.65%, I believe. I have a chart of the 10-year here that I have done a little trend line on since about 1987. The yield has been going down, the interest rate, I mean. We got to 2018 where we broke above that. We got to 325, and now we came back to 172 the other day when I took this screenshot. And at that point, we're at that support line, because technical analysis, of course, when you break through the trend line and then you retest it, That's you could say that is resistance when you're below, and then when you come back down, it's support. So even if we go a little bit below or a little bit above, we can go up or down from there. It's kind of a 50-50. If you look over here, the trend line, of course, is not respected by this little blooper here. But anyway, professional money managers, when they saw this, in my opinion, they started selling everything they could to buy treasuries, because as a professional investor, you are trying to buy securities that you think or know with very high certainty are going to go up in price. And of course, when the interest rate falls below 2%, like here, you know, you make lots of capital gains on the bond, because someone who's buying at 1.721%, he is paying a much higher price for the same coupon that the bond is offering. So this is kind of my explanation. There was this lady at the press conference who was talking to Powell and asking if he wasn't blowing his ammunition by lowering the federal funds rate, you know, without any need, and he kind of just like smiled at her, because, like, as I explained, the ammunition is not this, you know, the federal funds rate. The ammunition is the securities portfolio, the mortgage-backed securities, the treasury bills that the Federal Reserve has, and by lowering the rate and not defending that line, they are actually saving their ammunition. So goes to show that some people, reporters, have no idea what they're talking about, or they are just not sophisticated enough in the moment when it happens or when they hear it to understand what exactly is happening. Of course, you can now be thinking, well, if this was, you know, like, this makes all sense, but was it foreseeable that the interest rate on the treasury bills would fall below 2%? And I would say it's not foreseeable at the moment when this was when this press release came out, but money managers decided to do that. And the thing is, the people with the money, they decide where the prices go, and they push them to wherever they think they should be. And of course, over the long run, we will see whether they are right or wrong, whether a 1.7% interest rate on the treasury bills is over 10 years is going to be better than the stock market or not. But I think, you know, the news has been, you know, trying to get people worried and fearful and scared, and the people, the money managers who ran into this this rally in bonds, I always like to call it a pump and dump, but yeah, they sold their stocks at higher prices than they are trading now in many cases, and they went into securities, treasury bills that are higher priced than they were when they started buying them. So you could say that they have the option now to sell their treasury bills because it's a very liquid market, and buy back their stocks. And today, actually, we saw a rebound in the stock market, and it's going higher. So I would say that that is what they are doing, because I showed in my chart here, we are at a crossroad at this trend line where it's a 50-50, whether in the long term rates will continue going higher as they were, or whether they would be going lower. You can argue, of course, that in September Chairman Powell will lower rates because the 10-year is trading lower than the federal funds rate, and that is kind of part of the ammunition, whether they want to preserve their ammunition. And based on what they said here today, or not today, a week ago, they are saying that they are preserving their ammunition. So they probably are going to lower the rate again if the bond yields stay in this level. And it doesn't really matter whether they lower the federal funds rate by a quarter or half a percentage points. That doesn't really matter. Essentially, in theory, the 10 years used as a proxy for the discount rate that you should use when you're looking at analyzing stocks. And in theory, the valuations of stocks and bonds should move in sync, because when the discount rate falls, the bond goes up, but so should the stock go up. The only way to rationally explain why the stock market should go down would be if demand would be faltering, and I don't really know whether demand is crumbling. There were mentions about the manufacturing sector being in decline and the PMIs being low. This is part of the reason why Powell said that they are lowering the interest rate, because they want to jumpstart the economy again. It might work, it might not work, who knows? And overall, I think that I think that we are at that point where things could rebound in the stock market, like we saw today. But anyway, I'm just not going to like ramble on anymore. I'm just going to end the video here. Leave your comments if you agree, disagree, or have something else to say. I probably forgot to mention other things. And have a good day.